Hello class, hello Dr. Chen. This is Apu Lomban Tobing. I would like to represent my Excel project. I'm using financial report of JP Morgan Chase for 3 years, 2015, 2016, and 2017 for income statement, and also down in the bottom here it's a balance sheet for 3 years. And from this income statement and balance sheet, I'm going to calculate the DuPont analysis, which is I calculate here for 6 point net profit margin. Uh, it's net income divided by sales times 100. It's it's simply net margin. It's to measure how much net income or profit is generated as a percentage of revenue. Let's see from the table here, 26% 2015, 26%, same thing, and then 2017 went down a little bit to 25%. Now let's move to total asset turnover. With its total net revenue divided by asset. Uh, this formula it's a major ratio measure to value of a company's sales or revenue relative to the value of its asset. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using their asset to generate revenue. Okay, so let's see on the table here, the numbers about the same thing, 0.04 every year, nothing changed. Now let's move on to return on asset. Return on asset, or also we can call ROA, is a net income divided by asset times 100. It indicates how profitable a company is in the relation to its total asset. To determine how efficiently a company uses its asset uh, uh, to generate profit. So let's see on the table here how efficiently this company. From year to year, they're about the same thing, 1%, 1%, 1%. Now let's move on to equity multiplier. Equity multiplier is assets divided by equity. It's a risk indicator that measures the portion of company's asset that is financed by stockholder equity rather than by debt. Okay, so uh, on this table we can see the number is 9.50 2015, and move on a little bit 9.80, and move on again 9.91 2070. You can see on the top here the formula how do we get this percentage. Now let's see return on equity. Return on equity is or we can call ROE, net income divided by equity times 100. ROE is a measure of financial performance calculated by dividing net income by shareholders' equity. This is the thing, because shareholders' equity is equal to a company's asset, the whole asset, minus its debt. So ROE is basically considered the return on net asset. Let's see on the table here. The number, the percentage, but the same year after year. There's nothing changed. 10%, 10%, 10%. We always can see the how do we get the 10%, the formula on every column. And then the last one is net interest margin. Net interest margin is net interest income divided by asset time 100. Okay, and net interest margin is a measurement comparing the net interest income a financial firm generates from credit product like loan and mortgages with the outgoing interest it pay a holder of saving account and certificate of deposit. Remember, all this data is a banking data. The company is a bank, so I have to calculate also this. So now let's see on the table here how the percentage every year. And I don't see any change here. 2%, 2%, 2016 and 2%, 2017 and this formula. So all the DuPont analysis, uh, this is the result of the DuPont analysis for this company. Uh, we compare every years the how this number move, but also we can compare this with the DuPont analysis of the competitor. On this case, I compare with Bank of America, which is already calculated. So we can see here, for example, net profit margin of JP Morgan Chase is for year after year is more higher than net profit margin of Bank of America. But if we see the how this percentage move on, it's about the same from these two company. And also for another number, let's pick return on asset. JP Morgan is 1%, 1%, 1%, but and then Bank of America also same thing, 1%, 1%, 1%. Oh, this is very important. Net interest margin. Let's see, 2%, 2%, 2% every year from this company, JP Morgan Chase. And Bank of America, it's about the same also. Bank of America have 2%, 2%, 2% of their net interest margin. So that's all about calculation, ratio, analysis of DuPont analysis of JP Morgan Chase, and then also comparative with Bank of America. And thank you for watching.